Hey everyone, and welcome back. We're doing a deep dive today on some practical tax strategies. The kind that put more of your hard-earned money back in your pocket.
Exactly. We'll be looking at 7 tax strategies to lower your tax bill. And yes, we'll even be getting into Roth conversions.
Sounds good. Everyone wants to know about those. So are you ready to uncover some of those hidden savings?
Absolutely. Let's dive right in.
Okay, let's start with something that's close to home, literally. Did you know your house could be a tax haven?
It's true. We're talking about the home office deduction, and for the more adventurous, the Augusta strategy. Both of these can make your home work for you, tax-wise.
It's amazing. No more wishing you could write off that home office space. So for the home office deduction, as long as you use this space exclusively and regularly for business, you can deduct things like rent, utilities, even some mortgage interest.
Right. Think of it as turning those everyday expenses into legitimate business write-offs.
And that's where the Augusta strategy comes in, right?
Exactly. This strategy lets you essentially rent your home to yourself. Hold on, rent to myself. How does that work?
It's completely legal, and it can be incredibly advantageous. Let's say you're a consultant, and you decide to host like a 2-week workshop at your home.
Hmm.
By formally renting the space to your business, you create a deductible expense.
That makes sense.
And the best part is, the rental income might fall under a special exception for short-term rentals.
So my home office turns into like client meeting central for a couple of weeks, and I can write off part of my rent.
That's incredible.
Are there any requirements to keep in mind, though?
There are a couple of things. First, you're limited to a maximum of 14 days per year. Anything beyond that, and you'll be in regular rental income territory.
Gotcha, so no renting it out year-round.
Right. And secondly, you'll need a proper lease agreement. It's got to be between you as the homeowner and your business. And it needs to outline a rental rate that's comparable to similar properties in your area.
So everything has to be above board and well documented. It sounds like a really powerful strategy, but you need to plan carefully. Definitely don't want to run afoul of the IRS.
Exactly. It's always best to err on the side of caution.
Okay, moving from real estate, let's talk about some tax-savvy moves for all you entrepreneurs out there. We're going to look at hiring your child and employee achievement awards.
I bet some eyebrows just shot up at that first one. Hiring your child. But it can be a win-win situation when you understand the tax implications.
Yeah, this isn't about giving your kid a free pass. It's about using the tax code to your advantage.
Exactly. Now, when you hire your child, especially if they're under 18, their wages are exempt from Social Security and Medicare taxes.
Wow, that's significant.
It is. And if they're under 21, you also avoid paying FUTA taxes.
FUTA.
Federal unemployment taxes.
Right, so not only might you be teaching your teen about responsibility and a good work ethic, but you might also be eligible for some nice tax breaks.
Precisely. It's like a parenting win-win.
Love it. So what's the catch?
Well, this strategy works best for sole proprietorships or family businesses.
So if I've got a tech startup with multiple investors, probably not the best idea.
Probably not, no. You definitely want to talk to your accountant about that.
Good point. Okay, now let's talk about these employee achievement awards. Who doesn't love a little recognition for a job well done? Especially if it comes with a nice tax benefit.
Absolutely. It's a win-win for both employers and employees. When you give your team tangible gifts like plaques, trophies, a new coffee maker, whatever, those awards can be fully tax deductible for the business.
That's amazing. Are there any IRS rules about this, though? So it doesn't turn into a free-for-all gifting spree?
You're right to be cautious. There are definitely some guidelines from the IRS. For instance, the awards need to be for something specific, like recognizing achievements, length of service, or safety accomplishments. But as long as you follow the rules, it's a great way to acknowledge your employees and potentially reap some tax benefits at the same time.
I love it. It's like a bonus, but instead of cash, it's something they can really use. Speaking of smart spending, let's talk about accountable plans. I hear this is a great way to save money on those everyday business expenses.
They really can be. Accountable plans let businesses reimburse employees for necessary expenses. Without those reimbursements being taxed, we're talking travel, meals, office supplies, all those little costs of doing business that add up so fast.
Yeah, those can really sneak up on you. So with an accountable plan, the business can deduct those expenses, and the employee isn't taxed on what they get back.
Exactly. It's a win-win for everyone.
I love it when that happens, but there's always a but, right?
Well, you do need to make sure you have all your ducks in a row. The IRS wants to see that these expenses are legit, actually related to the business.
Right, of course.
So make sure you're keeping good records, save all those receipts, and make sure everything is accounted for properly.
Always good advice. Stay on the IRS's good side. So let's shift gears a little bit now, from business expenses to real estate investing. Specifically, we're going to unpack the 1031 exchange. I know a lot of investors are interested in this one because it can really help them upgrade their portfolios, without getting slammed with a massive tax bill.
Right, the 1031 exchange is like a get-out-of-jail-free card for savvy real estate investors. It lets you defer those capital gains taxes when you sell a property and reinvest. So say you've got a rental property that's gone way up in value and you're ready to cash in. Well, instead of paying a big chunk of your profit to Uncle Sam—
Which none of us want to do.
exactly, you can use a 1031 exchange to reinvest those proceeds into a like-kind property.
Like kind.
It doesn't have to be identical, but it should be a similar type of investment. Like you could exchange one rental property for another, or you could even trade up to something bigger and better.
That makes sense. So it's kind of like a strategic trade-in for your real estate holdings. Are there any time limits involved?
Oh yeah, the IRS is very specific about that. You have a limited window to identify and close on the replacement property.
Right, makes sense. They want to make sure you're not just parking your money somewhere.
Exactly. But if you follow the rules, the 1031 exchange is a fantastic wealth building tool.
Definitely something to keep in mind if you're in the real estate game. So we've talked about real estate investing. Now let's zoom out to the bigger picture of your financial future. We're going to cover two powerful strategies that can make a real difference down the road: the home gain exclusion and the magic of Roth conversions.
Both of these are essential tools for long-term financial planning. The home gain exclusion is a huge benefit for homeowners. It lets you shield a big chunk of your profits from capital gains taxes when you sell your primary residence.
Okay, that's huge, especially with the way the real estate market has been in so many places.
It really is. If you're single, you can exclude up to $250,000 of gains. And for married couples filing jointly, that amount doubles to $500,000.
Wow, $500,000. That's a pretty sweet deal. But I'm guessing there are some rules you have to follow to qualify.
You bet. You need to have lived in the home as your primary residence
Yeah.
for at least 2 out of the 5 years before you sell it.
So you can't just flip houses and claim the exclusion.
Nope, this one's for homeowners who are in it for the long haul.
I like it. So tell us about Roth conversions. I know a lot of people are confused about those, but they can be incredibly powerful.
They really can. Roth conversions are all about setting yourself up for a comfortable retirement. With a Roth IRA, you pay taxes on your contributions up front, so the money you put in is after tax.
Okay, I'm following so far.
But here's the beautiful part. All the growth in the account is completely tax-free. And when you take qualified withdrawals in retirement, you don't pay any taxes on those either.
Wait, so you're saying you pay taxes now, but then never again?
That's the general idea, yes. It's all about strategically managing your tax burden.
That's brilliant. But what's a Roth conversion then?
That's where it gets even more interesting. A Roth conversion is when you take money from a traditional IRA or 401k, which are pre-tax,
Okay, got it.
and you convert it to a Roth IRA.
So you're basically giving your old retirement savings a Roth upgrade.
Precisely. You will owe taxes on the amount you convert. But there are situations where it makes sense to pay those taxes now, especially if you think you'll be in a higher tax bracket in retirement.
Makes sense. You're taking the tax hit now to avoid an even bigger one later.
Exactly. Plus, once the money is in that Roth IRA, it has the potential to grow tax-free and those withdrawals in retirement. Tax-free.
It's like a gift that keeps on giving. So you're basically making a smart tax move today to potentially save a bundle in the long run.
Exactly. It's all about thinking ahead and planning for a more financially secure future.
Absolutely. Well, we've covered a lot of ground today, from home office deductions to Roth conversions. It's clear that with a little planning, you can really make the tax code work for you.
I totally agree. But it's important to remember that everyone's situation is different.
That's a really good point. So how can our listeners figure out which strategies are right for them?
That's where a qualified financial advisor can be incredibly helpful. They can look at your specific situation, your goals, your risk tolerance, and help you create a plan that makes sense for you.
Yeah, it's like having a personal tax and finance guru in your corner.
Exactly. They can help you navigate all the complexities and make sure you're taking advantage of every opportunity.
So as we wrap things up, what's the key takeaway for our listeners today?
I'd say it's that knowledge is power when it
Yep.
comes to taxes. Don't be afraid to ask questions, do your research, and get personalized advice.
That's great advice. And remember, it's never too early to start planning for your financial future.
Couldn't agree more.
Well, that's all the time we have for today. Thank you so much for joining us for this deep dive into tax-savvy strategies.
It's been a pleasure being here.
And to all our listeners out there, remember, with a little effort and the right information, you can take control of your taxes and achieve your financial goals. Until next time.